I came across a very interesting article the other day in Economic Times. It was dated Wednesday, the 19th November. I have it in front of me. It is written by Swaminathan S. Ankalesaraya Iyer, a very famous economist. I respect him a lot. His thoughts are very thought provoking. So sometimes I do not agree with him because he's a leftist thought processor. But his ideas are intriguing. That is what I would say because his thoughts are very, very broad based. My only angst against him is that he's talking from a very high pedestal. I think he must come down to our Indian level, is what my feeling is. For example, his article was on enough with the babysitting. Shielding banks with the antiquated SLR only breeds complacency and we should abolish. Now, what is SLR? Let me first explain to you, from my understanding. SLR is a minimum percentage of liquid assets that a bank needs to retain. It is evaluated as a percentage of the bank's liquid assets divided by an aggregate of the net demand and time liabilities. It ensures the solvency of the commercial banks and it is used as a reference ratio to determine lending or the base rate as you call it. Commercial banks are not allowed to lend below the base rate. Now this is the SLR, concept of SLR. What does it do? It means that a certain percentage, all banks have liabilities. Like for example, if you look at the demand liabilities, they are demand drafts, current deposits, overdue fixed deposit balances, etc. And there are long-term deposits, FDs, staff security deposits, savings bank, certificate of deposits, all of them come under borrowings. So these are the liabilities which the banks has to repay. So a bank cannot collapse. You know what happened about 2-3 years ago when a number of banks in Silicon Valley collapsed. A lot of people lost their funds, lost their living, lost their investments, everything, and even Silicon Valley was shaken up a lot. I'm talking about in billions of dollars. Now, if you look at 2008, there was what is known as the 2008 crash, and because of that, a very big investment bank, it collapsed. It has been existing for more than 100 years. Now, if you look at it, there was another bank case which happened in Singapore known because of a betting by a Singapore trader and Barings Bank. It was sold for $2. It was one of the biggest banks in the world, Barings Bank. So, what I am trying to bring out to the fore is that, when we look at the concept of a bank in India, we should be extremely careful of how we try to proceed with it. Well, SLR removal is a very interesting concept because, as he says, there are a few things which are very, very relevant. I'll try to read it out to you. SLR undermines discipline by guaranteeing the government a captive market for its bonds. The ratio shields policymakers from fiscal responsibility. Why should the government worry about overspending or inefficient subsidies when banks are legally obliged to buy its bonds? Now, this is the criticism he has about why the SLR should be abolished. Because it says that it indirectly funds the government, because all the banks keep the SLR in government. So when the SLR is maintained in the government, and the government issues a guarantee, it means that amount of money is guaranteed by the government. So if anything happens to the bank, any kind of run on the bank funds, any which affects the basic structure of a bank, then the government comes to its support to the extent of the SLR available with it. Sometimes, for example, there are a lot of cooperative banks and funds like the Hindu fund which collapsed. I knew a lot of funds which collapsed in the 1990s. A lot of people lost their investments. I know a few family members who lost lakhs of rupees at that time. So you can imagine losing a lakh of rupees in 1990 is equal to a crore of rupees today. So that is what happened. Nobody backed those funds. Nobody backed those small chit funds. Nobody, nobody could support them when the depositors lost their funds. Now, when we look at India, today India is on we are a small speck in the financial world. For example, why am I saying it's a small speck? Let me tell you. The deposits of JP Morgan, $812 billion. Bank of America, $372 billion. Wells Fargo, $258 billion. So, we are looking at comparing ourselves. Even the biggest bank in India, when we look at State Bank of India, I think it has got a deposit of about $200 billion. I do not know whether I'm right, but I can ascertain the figure and give it to you. But we are now not even in the first 50 of the banks, of the top banks in the world. That means we are still in the fledgling effect. Yes, we are growing fast. India is becoming the third, it's going to become it is transferring, or is going to be coming to the third level with regard to the world GDP economy. That is to say, we are going to become the third largest economy in the world. That is based on the population and the turnover and the consumption figures. It is not based on finance. If you look at finance per se, we are a blip in the market. Our debt market is very small when compared to the world debt market. The American market runs into trillions of dollars. We are not running into even $1 trillion. So we cannot, or I would say not even reaching the $500 billion market. I think it is time this is the point which I think I contradicting Mr. Ankaleshwar in my opinion. I'm not saying other people, they can always take a stand. So if you prospectively look at objectively, in the long run, when we are sufficiently strong, today, I like to take one step, the dollar. We are running after the dollar because we are not able to match the dollar in any way. We are not the manufacturers for the world. Unless we become a strong economy like China, and with resources like China with regard to the rare earths materials activities, and we have a lot of gold, like the US or South Africa, which produces gold. If we are having a very strong base, I'm sure we can look at it, looking at the SLR, we can reduce the SLR rate or give some banks a leeway to be away from the SLR. Because locking of funds are not, that means that so much of our money is not available to the bankers for lending. So, in one concept, the SLR is, I don't mean the argument of Mr. Ankalesh Roy is wrong. In one way, it is right, but unless we are on a very strong footing, why I'm going, behind this angle is that 10 years ago, but when the current government took it over, we were one of the fragile 5 economies in the world. That is to say, at any time our economy would have collapsed and we would have been bankrupt in a very short while. That was the extent to which our economy was shaking. We had external debts, I do not know how much at that time. I have to come back to you on that. Our gold was hawked in 1991, which we couldn't recover. Our oil bonds were to the extent of nearly 2.5 lakh crore, on which the government was finding it very difficult to pay the interest. There's so many factors we have to structure in, before we take this bold step. It is something that I would like to expand upon in my next video.